Okay, there we are. Hi everyone, welcome to this live event. As usual, I'm here to walk you through the Forex market for this week and comment a bit what's going on, both from the fundamental and technical side, right? So let's start by taking a look at the weekly calendar. Of course, oh, sorry, not that one. I want to share this one. There we are. This is the calendar. Let's start by saying that, well, how do I say this? Central banks are game changers, right? They always has been. And lately, and despite they are not taking much real action, they are surprising us with comments and promises and hints, right? Against all odds, we had a quite hawkish stance from Yellen at the opening remarks in the Jackson Hole Symposium last Friday, and all of a sudden, the greenback is back on track to be the king. Okay, I do believe that despite I believe I said this plenty of times, right? Despite the Fed has been on hold, promising rate hikes that never delivered. The fact is that the U.S. remains in the tightening path, while the rest of the economies around the world are easing. Right, we are expecting now Bank of Japan to add some easing. Australia has cut rates. New Zealand has cut rates in the last couple of months. They are both pointing to cut even further. The UK cut rates and may do a further easing if required. ECB Draghi also hint that he will add more stimulus if required. So at the end of the day, whether the rate hike from the US came in September or in December, the fact is that the imbalance between the Federal Reserve and the rest of the world banks is quite big, right? They are going in opposite directions, right? So I guess that the market is finally realizing that. Of course, there's a lot of saying ahead of a rate hike, and despite odds had increased largely after the Friday's event from July, the fact is that odds for a hike in September are still quite slow, It's not that they are going to deliver right now. Market is more watching for December as being the date for the next hike rather than this September. So we actually need US data to be supportive of such rate hike. We had core PCE inflation price index yesterday, and despite an uptick from previous month readings, the fact is that it's nothing really shocking, right? Inflation has been moving slowly higher in the US, but really, really slowly, really, really few, and really, really below the 2% target. We have discussed this with Yohai and Mauricio in the last Friday's coverage when the US released its GDP figures. There are some Fed members talking about the possibility of moving the Fed inflation target higher to 3 to 4. The fact is that at this point, 3 or 4 is as far away as it's 2, right? The economy may be growing at a moderate pace, but the U.S. economy is still not enough to fuel inflation. Growth in the U.S. is not enough to move inflation actually higher. So the inflation target is not what's relevant this day, is how fast we are getting to that target. Okay? Anyway, after such long introduction, I will take a look at the fundamental calendar at what we have ahead, right? There has been not much of big releases so far this week. In fact, we have a holiday on Monday in the United Kingdom. What came under my attention today was the fact that economic sentiment in the euro area has declined in August. It could be a late reaction to the Brexit, right? In July, Brexit comes at the end of June. We have July to digest the news, and all of a sudden, we have this decline in sentiment coming from Europe. I do, as I said, believe it's a consequence of Brexit, and I do believe that confidence will have a hard time to rebuild both in the euro area and the UK, right? But In fact, it did not affect much the euro for what I see so far. In a few minutes, we have German inflation. I was watching at the monthly reading that we're expecting is zero point 0.1 against previous 0.3. The annual is expected to tick higher, but well, if inflation is moving slowly in the US, it's moving even slower in Europe, right? And an uptick in German inflation would hardly be enough to support growth in the sector in indicator in Europe. I don't believe it. We need I don't know, inflation about 1.0%, sorry, all across Europe to start talking about the inflation rising, right? And I was watching the calendar. We have not much in the years. Consumer confidence could be a bit mover for the euro, particularly if it's good, right? Because the market is looking for excuses right now to buy the greenback. So if this report is good, then we will probably see the American currency gaining further ground. Uh, uh, Reserve Bank of Assistance Governor the World speaks in Australia in the upcoming Asian session. Uh, I don't know. I don't believe it's going to move much in the market, but it's the only thing I see during the Asian session that could affect currencies, right? Particularly if he keeps the path established by Stevens. Governor Stevens is leaving in August, right? We have a new governor in Australia in a couple of days. But anyway, what I mean is the Bank of Australia is saying that cutting rates and applying their economic policy measures, it's not enough, right? To boost the economy, not enough. The government needs to do something with taxes, with investment. His message was pretty clear. The economy cannot only rely on the central bank's decisions. So if Governor Odval has the same speak, I do believe that we could see some further Aussie weakness. Okay, then for the rest of the day, inflation in the euro area, right, is its next important macroeconomic data to watch. Not expected much from here, as I was saying. We need the monthly numbers to come up above 1.0% in all of the region to start talking about a firmer recovery, a stronger euro area. I would pay also some attention to, of course, the ADP report ahead of Friday's payrolls, but the ADP is not always the most accurate measure of employment in the US, not the best tool to anticipate whatever the payrolls may bring, but indeed the market pay attention to it. And of course, I will also, a reading above 180 will probably also support the greenback. But I do believe that attention will focus more on the housing sector because the housing sector was the root of the 2007-2008 crisis in the US. And pretty much the cause all the markets are behaving as they are doing these days, right? It affected the world, and the world is right now still struggling to recover from that crisis, right? Anyway, for the last couple of years, the housing readings had been surprising to the upside. We had really, really outstanding figures, and all of a sudden, a couple of weeks ago, we have a couple of negative readings coming from the housing sector. So beware of these numbers. Beware of these numbers because if they're actually bad, the greenback can take a hit. Okay. On Thursday, we have Chinese and Japanese PMIs. Okay. That will probably be the main market moving the aviation station. And the final revisions of manufacturing PMIs in the euro area, I won't be paying much attention to them. I do believe that the market will pay more attention to the one in the UK, right? If we have a better rating, which is possible, the pound could recover some ground further. Also, we have market in the US final numbers. Again, it will. I will expect them to move the greenback, depending on how the numbers are. But remember that we have payrolls on Friday, so we will probably see much of rate trading on Thursday, okay? And for payrolls, I was watching that we are expecting something around 180. Numbers have been quite erratic lately, with the May plummeting, July soaring, June soaring. So I do believe that 180 is more like an average wish than an actual estimate number. I don't know. Anything above 200 should be good for the US economy, okay? Of course, be aware of previous month revisions and of the unemployment rate. It's expected to tick back lower, but I could say that what's really important this Friday is how wages are performing. If we had an uptick in wage, that will be a bit more supportive of a US rate hike, okay? Rather than employment creation of the unemployment rate. The unemployment rate, as long as below 5.5%, it could be supportive of a rate hike, okay? I'm talking way too much today. Anyway, let's take a look at the chart. Let me change my screen. Share charts. Okay, there we are. Let's see what the year can bring us. As you know, I have been seeing this pair range bound for long. In fact, I have also commented that if you consider 800 as the base and 1460 as the top, the pair has been stuck within that 660 pips range pretty much for over a year and a half, with short-lived movements beyond that level beyond those levels, being quickly reverted. If we take a look now at the daily chart, the price is stuck between a 100 and 200 simple moving averages, both in a tight range, both heading nowhere. The fact is that the pair lacks clear direction in the longer perspective, but if we go to the short term, I do believe that there's bearish potential developing in here. I would expect that a break below today's low would lead us to test the 1120 region. Below that level, there's a stronger area in between 1070 and 1080. So that's the level to beat, right? 1070 to see a bearish acceleration that can take us back to those lows we see July around 950. But no, I believe I know it's 200 pips. The pair can easily move 200 pips in a couple of days, but I don't expect that much for it unless we have really shocking positive surprise in all the upcoming US macroeconomic readings for the rest of the week, right? And of course, payrolls. Anyway, and for what I have seen, the pair has been unable to recover the 12th level, right? We have short-lived spike above it earlier in the week, and the pair quickly reverted, so we need to settle above that 12 to see a recovery up to 1245. And there's a strong static support level, the resistance layer. So that's the main bullish target in the short term. And above that level, the pair can go back to 1290, 13. Actually, not seeing much more than this for the pair at this point because technical readings are pretty bearish. But if it does, we can go up to 1330. And that's the most I can see it going this week, okay? And for the pound, the bigger outlook, right? This is my daily chart. Show me that the pair latest recovery stalled right below this 3320 region, which is the 23.6% retracement of the post-bearish slump, right? It's has become sort of a line in the sand. I do believe that the pound is comfortable below this level, right? So I was saying the rally is still there, and we have correct 50% of that rally, right, this week. In fact, today we bottom around yesterday's low, the same low. Well, it's right. So that 3050, 3060 region seems to be a quite relevant support for the upcoming hours sessions. And if we break below it, I would expect pair to go to 3020. but it will take a break below 13 or to see a steeper decline. I would say around to 90, 29, sorry, 50, 40. That's the main bearish target for me this week. And what I'm seeing also towards the upside is that this Fibonacci level, the 38.2% of this latest bullish run, is around 33. Yeah, 31.20. So I would like to see candle opening above this level to see an upward move up to this region to 31.80. Still, I do believe that we may see some selling interest if the price reaches this much. Sorry, during the upcoming days. Okay. For the Aussie, the pair has been quite bullish, right? But it broke lower. It broke sort of the daily ascendant trend line these days. Yeah, there we are. And what I'm seeing here is that it also break below this 76 figure, which is also a yearly Fibonacci retracement. So I do see that the bearish potential in here is present, right? But we have no momentum towards the downside. I'm thinking that it has lost its shine, and we can go down to 74.50, which is a critical support. Take a look at this daily chart, how many times the price is still around that Fibonacci level and how relevant it is. So I would wait. At this point, I would wait with the Aussie. If the pair breaks below this level, I believe that we have scope to go down to 72.50. More if we have more dovish talks coming from the Reserve Bank of Australia, and of course more hawkish coming from the US, both aligned, I mean, but that would drive the pair down to 72.50. But this is for me sort of line in the sun, and if the pair has reaches this level, of course, and has trouble to break below it, I will attempt to buy around there. On the other hand, if we go back above 76, I do see that will signal a stronger recovery, because that will mean that the market is still interested to buy on dips. I would expect it to resume its advance and retest that 78.30, which is this year high. In the short term, I would say that this weekly low we had 75.20 is the main support, right? And below that, the 74.50 we were talking, and towards the upside, as I said, 76 is the key. Above that level, 76.40 seems the next strong resistance level, intraday resistance level to beat. When it comes to the dollar Japanese yen, I do believe that the risk remains towards downside in here. Take a look at the daily chart. I will make it smaller, right? If you take a look at the wider look, it's hard to see this pair bullish. It's developing well below its 100 simple moving average, the blue one, the 200, it's the brown one. Both maintain their bearish slopes. I know indicators have recovered above their midlines, but they're lacking enough upward momentum. And to talk about a bullish breakout in here, we need to go above 105, right? Still, the pair is struggling around this 165 level, right? It seems to have held above it. And of course, it's still not confirmed break, because we are talking about the long term. But this is the 50% retracement of the Abenomics rally between 2011 and 2015, right? Over 4 years rally. So it's quite a relevant level, okay, for me. And if you take a look, the pair has stayed there plenty of times. So both short term and long term. So as long as above that level, there is a slightly hope that the recovery may extend, but it indeed will depend on how the central banks react in September, of course, what Fed stance, and particularly what the Bank of Japan will do, because the Bank of Japan has been talking so much about adding more stimulus that at this point I do believe that they had to, I don't know, hundreds of thousands of billions to be able to actually convince us that they are willing to do anything to weaken the Japanese yen, right? Nothing that we're seeing these days. Anyway, as I was saying, 105, it's like line in the sun. To talk about the bullish continuation, the pair needs to move beyond that level. It's true, and when the pair, this particular pair, finds a trend, it follows and follows and follows, and does not pull back, does not correct most of the times, of course. So beware of an upward acceleration of positive US nits. Also, uh, dollar termination tends to range bound ahead of the payrolls, right? I won't be expecting much for the upcoming days. Okay, not at least until the ES release the employment figures. Anyway, 100 to 60 is the immediate resistance ahead of 103, and above that level, the pair above. I do believe that it can go. It has not much in the way up to 104. So those are my levels to watch these days. 101.70 is the first support. The 100.65 is the next one. If we lost this level, 100 seems possible for the next few days or sessions. Okay, let's take a look at gold. The commodity has been trading alongside with the Fed decisions for over a year already. I have said this plenty of times. Anyway, I do believe that we are clearly in a consolidative phase, right? Unable to set a certain direction, and it seems that it has held pretty well to the fact, to Chelen's words, it has held pretty much. So that's limiting the risk towards the downside. I do believe that 1308 is a sort of line in the sand because it's the 38.2% retracement of the latest bullish run. If you take a look at the chart, we have some lows around that level, and we have the 100 simple moving average slightly below that level. So this region, 1308, is the line in the sand. As long as above that level, the risk towards downside seems limited for me. Okay. Of course, if we break below it, I can see it going down to 1250. But if it's not going to break, the only way it can break is, I do believe, is that if the Fed actually pulls the trigger, right? I won't be expecting much of an upward recovery, but some further consolidations. Sorry. Shorter term, we have some resistance around 26, 27, right? That's for me the immediate resistance level, 26, 27. And another one between 33, 30 and 35, 50, 60, which is where the commodity has been stalling most of these days, bottoming and the Fibonacci support. Above that level, we can go back to 1342. I'm not seeing much of an upward potential right now in the short term, but if it does recover, 1352 will be the next resistance, okay? And towards downside, I was saying that 1308 is the key if we lost it, be ready for a sharp decline. And when it comes to oil, the fact is that the market is not sure what to do with oil. We had once again most of OPEC members saying that they are willing to talk an informal meeting scheduled for late September. Non-OPEC producers inviters. Market start to believe in an output freeze. Saudi Arab oil minister said, no, don't count on that. Pretty much he said that. So the market is now looking for direction. Anyway, it's holding pretty well. And I do believe that in between 45 and 50, 52, it's a logical value, sort of speaking, and the probable levels where we will going to see during the upcoming month, right? We have movements out of that range, but the price tends to return to that range. So I do believe that above 45 or approaches to 45 would be an interesting buy, and movements beyond 50 will be an interesting sell. Okay, but not much more for oil at this point. I forgot to say about gold that I would hardly expect it to rise sharply beyond 1400 at this point. Okay, anyway, I spoke so much. I'm already tired of speaking, so I believe that's it for today, guys. Thank you for being here with me. Thank you for watching this video. and see you back soon. Okay, thank you and bye bye.